Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. But before that, I need to give a little kudos to our marketing department. For those of you that are joining us for the first time, you may not notice, but for those return viewers, you might notice a new logo, new theme. I think it looks pretty sharp and I like it a lot, but hope you do as well. And let's go ahead and get started on this week's Markets in Focus. So the US yield curve is flattening. The Fed just raised rates this week for the first time in a few years. Let's talk a little bit about the expectations, how the market's reacting, and some of the concerns around a flattening or inverted yield curve. Number two, another way of looking at the bond market, the MOVE index, the expected volatility of treasuries. It's actually been showing some signs. Maybe it's peaked here recently, which could be a good sign for equities. And finally, if you're looking for pockets of optimism as you navigate kind of the weight of the evidence of various indicators, one stands out in terms of short-term momentum firming up underneath the surface. We'll unpack that a little bit today as well. So the US yield curve is flattening. On the chart here, we have two different ones. We have the yield curve on the bottom that is from December 31st of 2020. Why is that significant? That was, of course, right before the really strong rally in 2021. S&P 500 was up nearly 27%. Investors that were holding the S&P 500 index or securities that mimic that index only experienced about a 5% drawdown the whole year. So it will historically go down as one of those really strong bull market years. And if you looked at the yield curve preceding that, you had a yield curve with long-term interest rates much higher than those near 0% short-term rates, which meant that market participants had a very optimistic outlook for longer-term economic strength, which translated to strong equity returns. Things have changed a little bit here in 2022. As you can see on the chart this week, this is post-Fed decision. Over the past several months, we've seen short-term and long-term rates increase, to be fair, but short-term rates have been increasing at a much faster rate, which leads to what we call a flattening of the yield curve. Now, on its own, a flat yield curve is not necessarily the end of the world, but if it continues to flatten or becomes inverted, where long-term interest rates are actually lower than short-term interest rate, that would be a sign that market participants are actually saying the Fed might be pushing short-term rates too far, too fast, and the economy may have some trouble down the line. So that's something to watch because that inversion has happened ahead of several recessions historically. Now, bond market risk, the MOVE index, which looks at the implied volatility of options on US treasuries, has been surging since the fourth quarter of 2021 last year. And one of the reasons we were a little bit cautious from a bond market perspective and an equity market perspective, but we started to see some slowdown in the momentum post-Fed decision. We've actually seen that it has drifted lower as well as perhaps participants are getting more clarity on the direction of the Fed. Big wild card, obviously, the Ukraine-Russia conflict or war rather, and just how that unfolds, what additional sanctions, does that de-escalate? That could matter quite a bit. But I think from a bull market perspective, even for equities, I think you would like to see this decline back to more normal levels, which would indicate that potentially default risk and overall expectations of bond market risk have declined. And then finally, as I said, if you're looking for pockets of hope within the equity market, we've experienced some pretty significant volatility in the S&P 500 to start the year. Small caps and mid caps have been performing poorly for the past 6 to 12 months. This might be one indicator to look at here in the near term. This is the percentage of members on the New York Stock Exchange that are trading above their 10-week moving average. And we can see really near term, we started to see an improvement in this line chart here where you start to see some higher lows and a rise in the percentage of stocks that have been trading above their 10-week moving average, which means more and more stocks starting to get back into an uptrend underneath the surface, most notably small caps and mid caps, which, as I mentioned, have been lagging since really February of March of last year, started to show a little bit of strength here during the past couple of weeks. Still early, but I think it's a good sign in the near term, at least from a technical perspective. And finally, want to thank everyone for watching, but also leave you with some good news, bad news, depending on your perspective. U.S. Senate has passed a proposal that will now shift over to the House for a vote that essentially gets rid of the daylight saving time practice of changing clocks 2 times a year. Of course, many of us probably a little groggy after the changing clocks here this past week or so. And going forward, this could be as soon as November 2023 is what the bill calls for. Surprisingly, it was actually unanimous bipartisan support. This was the issue that brought both sides together. House, based on Pelosi's comments, is actually very receptive and on board for this as well. So longer term, this could be going away, the changing of the clocks 2 times a year, but maybe delayed a few months, as the House has said they're still focusing on some issues around the conflict and some more pressing issues than obviously the shift in daylight savings time. Perhaps a big change of something most of us have been used to for decades now. So with that, I want to thank everyone for watching, and I'll see you next time.